Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, June 29th, 2018. This will be a market update. We're going to look at, I wanted to cover the broad market, and I'm going to go into a few different sectors and touch on oil real quick because I think those are important drivers of the market right now. So these are things we need to watch for. Before I get into the charts, just a quick housekeeping note. I'll be taking my family on vacation today, hitting the road after lunch sometime today. I'm going to do a working vacation. I usually do that in the summer. Bring some couple computers with me, a couple laptops, and so over the next couple weeks. I may be a little slow to get back to reply to questions and chart requests and all that, but I will be checking in usually at least a couple times a day or once a day at minimum on the market. So I just want to let you know that market commentary and videos might be light over the next couple weeks. And this afternoon I will be on the road all day, so I would love to do an update. I'm dying to see how the markets close today. I think that can set the tone for next week. If be driving through and staying in a hotel tonight. If I get in early enough, if we pull off the road and check into a hotel early enough, I'll try to do a brief market update. Probably not in video format, and post that on the site, depending on what happens today. All right, let's dive into the charts real quick. SPY. This is a daily chart. Same story. We had that recent bearish PPO crossover, but the trend indicator, excuse me, longer term trend indicator, or at least the daily trend indicator is still bullish. That's that 9 EMA being above the signal line, as it was all this time here throughout 2017. Said the trend was bullish. Then during this corrective phase here, we had it bearish. So that's what we need to watch, bigger picture. And I'll get into the 60-minute charts in a second. We'll focus on those. But again, as pointed out, we recently had the third bearish, or well, actually the second bearish PPO, no, third, yeah, one, two, three. I'm sorry, that error was from below. So it's these bearish PPO crossovers that come, and usually they portend more downside. Bigger picture, we need to take out this trend line and that 268-ish support. You can see that support level, support here, resistance back here, resistance back here, a couple reactions along the way. So that's what needs to go on SPY. And the bigger picture has us below trend. Again, the S&P 500 is below trend, that primary trend line, whereas QQQ is not. We'll drill down to the 60-minute charts in a second and then take a look at a few sectors as well as oil. I want to point that out today. So here's QQQ, still above trend. These trend lines go back quite a way. You can see all the way back to mid-2015 for QQQ, but most markets picked up here in early 2016. So those are the trend lines I'm watching, and so the primary trend remains intact on the Qs, which is mostly tech stocks, until and unless this goes. And again, same story. We had these bearish crossovers recently, including this most recent one right here. If history is an indication, last couple times we had those, they're pretty good sell signals, intermediate term sell signals. So I do believe there's more downside. And let's zoom down to the 60-minute charts, and I'll show you what to look for. All right, so here's that the positive divergence I pointed out yesterday, possibly even the day before. And it was confirmed, as I mentioned yesterday. Confirmed meaning we had a bullish crossover, which at that point effectively gives us a higher low. And that is, at least in my book, that's when divergence is confirmed, when you have a higher low. And because until then the lines can still be pointing down. Now, what I still expect is, I was looking for a little pop here, and we've got a little pop so far, and I think that's good for the bearish case. If, of course, obviously, if we stay, and I'll show you the levels right here. Well, you can see it right there, that 174.14 level. If we remain below there, that's good for the bearish case, because what it'll do is, energize a lot of bulls, dip buyers, squeeze out some more shorts. I think maybe we got a little bit too bearish right here, too many people shorting the market, and that would set the stage for a move down to my third target there. Let me add another line for you right here on this chart. Let me zoom those levels in and then give you a line right about here. You can see we have a reaction high. We have a big old gap right here. We have reactions back here. So I believe I covered this in the video yesterday. This is really my uppermost bounce target slash threshold. Somebody asked me today, Randy, where would you start covering shorts? And that, of course, that answer to that question lies on your particular entry. It depends if you shorted here, 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 or here. It's a big difference. But where the bearish case starts to diminish significantly is if this level gets taken out. This is a very, in my opinion, a very significant and solid resistance zone right here, about 174.15 to one down to 173.55. You have this reaction high. You have a big old gap right here. You have reactions all along the way here throughout the year. So that's what I'm looking at right now as a uh, likely stopping point for this rally. And it'd be preferable to see us reverse before then. I think that would be even catch a lot of traders off guard and set the stage for the move down to that third target there around 166.85. And again, if we take it out, especially on a daily closing basis, that would be very, very quite damaging for the near-term bearish case. Might open the door for new highs again if we close up above there. And you can see the upper threshold limit would be the top of that gap right there. You can see the gap right where the crosshairs are. So that's QQQ. So again, my preferred scenario at this point remains something like this. Might not take place until next week. We'll see. Reverse anywhere between here and that level. Come on down to that 166.85-ish level. Still put in a divergent low, and that's where I'd look to be, going, reversing from short to long. And on SPY, we have this downtrend line here. This is what I'm watching on the 60-minute chart. There's a couple reactions there that I cut off, so we can take this line, we can move it up just like that right there as well. That's probably a better fit. Let's try to move that line there, zoom right in. There we go. All right, so that's the trend line I'm watching right now. Making a big mess of this one here, zooming in like this. There we go. Trying to capture all these reactions up here, and that's where we're at now. So I like where we're at right now. Yes, we have these divergences. They are playing out. Normally, as I said yesterday, this is my go-to. This is usually when I'd be getting aggressively long after a 60-minute divergent low during a bullish primary trend. And maybe it plays out. That's the thing. If you're bullish, and I said this the other day, if you want to buy the dip down here, we're at support. We're at support on the Qs. We had divergence, and just set your stop or trailer stops up, and maybe we break out of here and head on to new highs. But there's still, in my opinion, a significant level of resistance. I just went over it on the Qs, and look at all these reactions. Look at all these reactions here, reactions, reactions. So this is our comparable resistance zone on SPY, 274.28 down to 273.32 roughly, as well as downtrend line resistance. We popped it on Qs, but we haven't taken out on SPY. So, we have one, and in fact, a more significant, index, the SPY S&P 500 at resistance. The 60-minute trend indicators on both SPY and QQQ are still bearish right now. The 9 EMA is below the zero line. So that's what things look like. Those are the levels I'm watching on the 60-minute chart. And again, at best, I won't be able to update that until later tonight. We'll see what happens today. Now, let me just go over a few more things that stand out to me. Let's start with oil. Oil is a big driver of the market today. We have the energy stocks up. I have a watch list. Well, here we go. I'll just show it to you. Here's the biggest gainers right now by far in the S&P 500. The energy stocks up about 1.5%. Why is that? Oil's rocketing up. I see not just a pause in this rally. I see a sharp correction coming soon, substantial one. We had a divergent high right here. That was pointed out a few months back. We had a very sharp correction afterwards. And now we pushed up, and this is a near vertical rally. It's also another divergent high. You can see this is how those lines were drawn before. We had divergence there, and that divergence has simply been extended. So it has not gone away. Sure, is there the potential for it to be burned through if prices keep going higher? Yes, but let me show you one more thing and why I think we're going to see a sharp reversal in energy stocks, and that will play into put pressure on the broad markets. Let's go to a clean board here. And this chart goes back 2 years. It's just a daily chart. I made mention of this in the trading room today. Just follow these arrows. Look what happens when we have, this is what I call a near vertical rally, when you have prices going up nearly vertical. Look what's happened in just about every single instance that we had a near vertical rally. This one we did have, and actually this one's a little more sloppy. Look at these candles. There were pullbacks along the way. See this correction. When I say near vertical, I'm talking no givebacks. Just every day is up. You know, if you see a red candle, it's virtually flat. Boom. There's another one. Boom. See, there were givebacks here. So these were corrections along the way that helped work off the overbought conditions. Here's one. Boom. Um, this wasn't really a near vertical rally, but there was a sharp correction. This one's near vertical. So that's it. And, you know, there's no guarantees in investing and trading, but I expect this to end like those other ones, and not just end with a sideways consolidation. How much more upside to go? Hard to say, but you can just kind of eyeball these rips and dips. You know, the markets, there's even during an uptrend or a downtrend, I mean, there's self-limiting factors. You know, stocks or securities, especially some commodity like oil, can only go up so much so fast before market forces check it. You know, you get overbought near term, and then you get those corrections. So, if that occurs, you're going to see obviously pressure on the oil stocks because oil stocks follow. Um, Oil, of course, the energy stocks, I should say. And there it is. We had a divergent high at this point, and that divergence has already started to play out. Trend's still bullish right now, so you know you can't write the energy stocks off yet. There's that signal line 9 EMA on the PPO, doing a good job of back testing and starting to curl up there. So, however, you have a wall of resistance here, very significant level on the energy stocks around 78.50, a triple top so far. Let's see what happens. And again, with the ascent that we just had in oil, or we're having right now, uh, you know, the upside appears limited right now. Let's say, I don't know, 3, maybe 4% more upside, if that. But we can reverse anytime. And if so, that can flip this trend indicator bearish, have these divergences play out for more than this correction so far. So, by the way, that's a 6.3% weighting in the S&P 500. What else is driving the market today? Well, financial stocks. Let's take a look at these. Normally, I don't cover sectors in the public videos, but since this all ties into the broad markets right now, let's take a look because I do think this will have an impact. This is the second largest sector in the S&P 500 behind technology. Technology is the largest. It's even grown over the last year. It's now a 26% weighting of the S&P 500, whereas financials are about are a 14.2. I checked it today. All right, so let's look at this. Here we have a trend line here that comes off the early 2016 lows, just like the stock market. However, the financials are well below trend. Let me just color that line. It's very significant. So this is a primary uptrend line break. And you can see, so again, goes back to early 2016. Let me just jump back to the daily chart that zooms in. So we're below, we broke down, we back tested. That that is bearish. There's some cross currents. Just like I said the other day, there were cross currents in the broad market, and those cross currents were the bullish divergences. You know, I can make longer term charts have some significant bearish developments, but then there's some bullish developments I mentioned on the 60-minute charts. And what you have here is I'm watching this too. There's a falling wedge that comes right on the heels of this primary uptrend line and breakdown. So you can see we broke down, back tested, and so the bigger picture is this. Watch the financials to see which way this is resolved. There is potential divergence right now. They're up today. That divergence could be confirmed on some more upside. We had almost divergence here. I think that RSI made a slightly lower low, but I would be remiss not to point this out. However, so you have again cross currents, bearish longer term with that breakdown, but we do have this potential divergence setting up. However, again, I know I'm saying a lot of ifs, and this is why I don't have a position in the financials right now. The trend indicator is below zero and has been for a while. It's bearish, actually. You know what? Yeah, it actually, well, it flatlined there right around that point. I wanted to, this point here it was really walking the line, but it's been bearish since this point. Was bullish all along there. So let's see what happens. Keep an eye on the financials again because they are such a significant weighting in the S&P 500. Oh, and what I wanted to say too is the Fed stress test came out yesterday, and they approved everybody, but who was it? Goldman Sachs and a couple of them. Goldman Sachs and Morgan Stanley, and of course the U.S. arm of Deutsche Bank. But no surprise there. You know, Goldman Sachs, Morgan Stanley are two of the biggest stock market casino financial institutions out there. So no surprise they had to freeze their dividends. The rest of the banks, what I'm getting at here is immediately all the big banks, Bank of America, Wells Fargo, JP Morgan, they all up their dividends by, 50, almost 50%. JP Morgan up their quarterly dividend by 43%. Bank of America raised their dividend 60 cents. They're all announced, most of them announced big share buybacks. That should be huge news, but why isn't it? That's what I'm seeing. This is obviously the financials are up, but not as much as you might think they would be. I think that's a little pause for concern there. Um, and the fact the Fed stress test, I mean, that's a joke. The Fed was the one that fell asleep at the wheel and let the financial crisis happen. They inflated the bubble. It's like Bernie Madoff doing his own audit. It's just whatever. Yeah, I just don't put any stock into the Fed stress test. That's just me. There, anyways, here's a level I'm watching on financials. 2691-ish was resistance here. You can see a big green candle, an impulsive breakout right there. Pull back to back test it. Lots of tests. There were a couple false breaks below it. But this looked like the real deal so far because these were just 1 day or intraday candles. Then we broke down. We are back testing right now. So the financials are in a precarious or not a precarious, let's just say a key technical level. They're back testing this. If they get above it, then they have that downtrend line to contend with. And of course, this 28, 27 level. So just there it is. This is a sector to watch. And again, I can certainly make a bullish case like I am here, near term based on this or intermediate term based on this pattern. But again, the longer term picture looks bearish to me. So there's some cross currents. And again, yes, that's iffy, wishy-washy analysis because I presented both sides, but I don't have a position. Yeah, I'll just watch and see what the financials do. And I think it's being that it's such a big weighting on the S&P 500, it's worth watching. And then XLK, one of the other sectors up today. Let's just look at well, there it is. You can see this kind of sloppy price action here. Let me see. I have some other boards that might show a little bit better. There we go. Here's XLK. You can see all the way back. This trend line goes to the left of the chart. This is the primary uptrend line, still above it. XLK, virtually mirrors QQQ because this is a tech ETF and QQQ is over half tech. There it is. Big negative divergent highs. Trend indicator still bullish at this point right now, but these divergences portend a likely trend change coming soon. I think that trend change will be, this year in 2018, a break of this trend line, this primary uptrend line, come on down here to 63.21. And again, tech is, the biggest component of the S&P 500 at a 26% weighting. And zooming down to the 60-minute chart here, this is near-term stuff. This is what you need to watch. Call that 70. I had 69.94 right here. In fact, I can actually pull that line up to that reaction high. I think that's a key level to watch. You have a gap right here. And you also have a little bit of resistance. You can also maybe go in for a backfill of that gap. You have reactions, 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 breakdown, back test, and a failure. So like everything else, mixed bag of technicals. You're back testing resistance. You have this 60-minute divergence. That's usually my cue to get, aggressively long when you have divergence on the 60-minute time frame. But these trend indicators are below the the zero line right here, this 9 EMA. You can see all this time right here. Told you be long tech. Tech is bullish. Right here, bearish. Here it was bearish, wasn't very long, and before that coming into for most of the year it was bearish. So that's it. These are the levels to watch. If they happen to pop it, wait for daily close and also look for potential gap fill, but that's it right now. So tech, one of the biggest sectors at resistance, financials, or tech, the biggest sector in the S&P 500, and of course the NASDAQ 100 at resistance. Financials, second biggest at resistance, and that's pretty much it. So here's SPY, just a quick update as I wrap this video up. You can see so far a failure, a red candle, kissed that trend line perfectly that I adjusted earlier in the video. There's room for it to work its way down if you are bullish. Come on down here. I'd like to see a move down to 268.05. Extend these divergences a little bit and then reverse. Still put in that, there's plenty of room to have another thrust down and keep these divergences alive and well. And then maybe eventually go on and break out above that downtrend line. That would, this would set up, in my opinion, this would be the next objective area to go position long for a swing trade. And same story in QQQ again. I like that scenario that I've been maintaining since yesterday. A little pop above here to fake out move, and then another thrust down to T3 right here, 166.85-ish. Extend those divergences and set the stage for a more lasting and significant rally like this. There it is. All right, guys, this has been Randy Finney with Right Side of the Chart. And again, I'll do my best to post an update tonight if possible. Just don't know how late. We're going to be driving through from South Florida all the way up to Northwest North Carolina. So long drive, and we'll just power through as long as we can. And if I can do an update tonight, I will. If not, I'll try to do it tomorrow evening when we get settled.